Hello and welcome back to my series on learning how to model with the guide of the ModelOff World Financial Modeling Championships. Today I'm doing the last question from 2013 round 2, which is about M&A modeling or LBO modeling, depending on what you call it. A couple of quick bits of housekeeping before I jump in. There's a 45-minute problem, so I'm going to try and keep the whole video to 45 minutes. I have added a folder here for the finals of 2013. I haven't actually put the files in yet, but knowing that I have said in the video that I'm going to have them here by the time you see it, and knowing that this video is going up at 9 o'clock tomorrow morning, will hopefully force me to actually put those files in tonight. I think I've mentioned this before. I'm not planning on doing videos on the finals questions. I think they're probably just a little bit too big and too long to work well in this format. I think they're kind of probably not bite-sized by average YouTube viewers' attention span, but more bite-sized, 20 to 40-minute questions work better for this. The finals, the big financial models were like often 1.5 to 2.5 hours, and they weren't ones that you could kind of do in half that. For the most part, they weren't ones you could do in half that time. So that's that. And second piece of housekeeping is I'm not going to be jumping straight into 2014 next week because next week is an FMWC round, so I'm probably going to post a little something getting ready for that, or maybe something a little different. But then I'll jump back into starting 2014 the week after that. And I think that's it. Oh, sorry, last thing. So I've got the instructions here. I've also got the Excel file over here. Just to mention, if you're trying this, if you downloaded this file in the early days of when I put it up, you might have version 1. Just make sure that you have version 2. The way you can tell the difference is two things. One, these numbers here, this 11% and 6.8%, are just exact round numbers in this file. It's exactly 11% and exactly 6.8%. And the other one, for some reason, they had a bunch of extra decimal places that slightly changed a bunch of the answers. So there's a little, version control notes here. So if you see that, and if you see exactly 11% and 6.8%, then you're in the right version, and your answers, if you do your workings right, will match, and that's good. Don't worry about all the ref errors, that's deliberate, we're going to fix those. All right, so let's jump over here. So introduction is you've got a merger model, forecasting returns on an acquisition, but it's broken. So there's a bunch of ref errors, a bunch of formulas missing. The cash flow statement has mostly not been done. I think the logic here was basically, it would probably be too much to expect someone to build a whole M&A model like this in 45 minutes with the complexity that they had, but they lay out most of the structure and have you do most of the workings, is kind of the thought process. So anyway, there's a bunch of details here, which I think for the most part, I'm just going to kind of come to them as I hit them in the model, rather than trying to read through everything at the start. So a couple of general things. Transaction date, I think that's already an assumption in here, the transaction dates. Don't worry about that. That's in there. All the kind of numerical assumptions here are also in here. So like whatever that 6x exit multiple is over here and so on. So all the operating assumptions, it just says go find them in the model. It's fine. All cash flows occur at year end, so that's just a simplification that, when you think about calculating interest on debt, you just use the opening balance, because the balance doesn't change until the end of the year, so you don't have to think about averages or any funky stuff like that. Taxation and interest are paid at the end of the year, no accrual is necessary. Tax will be charged 30%, but no refunds for tax losses, and tax losses don't carry forward. So in other words, if you make a loss, no tax that year. If you make a profit, 30%. Then this one, basically, what this is telling you is there's no goodwill. So once you've filled out the balance sheet, obviously starts off very broken. Where is it? It's here. But once you've kind of filled out every other piece of the balance sheet except PP&E, it's just telling you PP&E is the sort of balancing number there. CapEx is spent on the last day of the year. Depreciation is calculated at the end of the year on the opening asset balance. So it's just a kind of simplifying assumption. Then it's kind of detailed assumptions on the different pieces of financing. And last thing, interest calculations. So yeah, again, I think this is just kind of repeating something from earlier, but calculated on the opening balance, paid at the end of the year. Same logic for interest earned on cash at the bank. And just telling you what shouldn't be part of cash flow available for debt service. Okay, so let's jump on in. One one kind of simple thing to check is just, anytime you have a ref error like this in a model, if you press Alt-TUE, which is trace dependence to an error, it'll take you to, okay, so here is the source cell. In other words, this formula does not contain an error. It just points to another cell that contains an error. This formula doesn't contain an error. It's just multiplying two values together. But this one contains the original error. So in other words, here we're missing LTM EBITDA, which we should find from this income statement here, except it's not populated. So we're going to start there by fixing that. So we've got the revenue, the COGS, and the other operating expenses populated. So we're just going to say, and note that these have a negative sign, so we're just adding them up. If they had a positive sign, then you'd want to subtract, obviously. And we don't need to complete the forecast yet, because now we come back up here and we can link this to the LTM EBITDA. And sorry, I guess the labeling is not totally obvious, but this LTM here is telling you. So 2013 actuals is what we take as the last 12 months, because the transaction date is the 31st of December 2013. Okay, so now we've got that working, then we come up here, that gets that working as well. So again, let's do the same thing here, figure out so the source issue here is the enterprise value is not populated, but we've got the EBITDA, we've got the entry multiple, which we're told is an EBITDA multiple somewhere. So then we fill that in, and now TUA, I think. Yes, TUA to get rid of all the dependency arrows that we've drawn. And now everything was kind of depending on that. So this top section is working now. So now let's move on down. We want to fix the income statement next. And it doesn't, you'll see in a minute, it's not going to work to just kind of go from the top to the bottom. The other way that you might be tempted is to kind of follow the order of the instructions here. Neither of those will work perfectly, because in a model like this, there's too many interdependencies for that. But it's not a bad way to start, to just work as far down as you can before you have to branch off and try other things. So revenue, well, we've got a revenue growth assumption here. I have no idea why you would have a revenue growth assumption and then a percent growth calculation in here. But I guess in theory you might use it for a check, but it seems to be just reinventing. But anyway, so we've got COGS margin, so COGS as a percent of revenue. So we're just going to, and again, note the minus sign, so I'm putting in a minus sign here, minus 82% times revenue, carry across. Then other operating expenses, again, X depreciation as a percent of revenue, so just minus that 10% times revenue, copy across. And then EBITDA, we already filled in the formula to link it to those other three, so that's fine. Depreciation, we'll need to work out the PP&E to do that. Amortization of new financing fees. All right, so here's kind of where we run cold on the income statement. We'll come back to that in a bit. Cash flow statement is probably going to be the last thing we do, because we'll want to have as much as possible of the income statement and the balance sheet working before that. All right, so let's talk about it's here and it's up here as well, the reference to capitalized financing costs. So that's somewhere here in the assumptions. Upfront financing fees are 400 bips. They're initially capitalized and then amortized equally per year over 5 years. So let's see, where's that 400 bips? Somewhere up here. I thought, yeah, here we are. So there's your 400 bips, 4%. There's that being multiplied by the total debt. So we get our total cost of 6.7. And again, I've kind of done the pre-exploring of the rest of the model. I guess maybe I'll just explain that to you now quickly as well, so that it doesn't seem like I'm too much pulling a rabbit out of a hat. So we've got an income statement here, got a cash flow statement here, broken down as, we start with EBITDA, then we make any adjustments from there to get cash flow available for debt service. Then we do the cost of our debt servicing to get to net change in cash. We've got a balance sheet here. We've got a debt and net working capital summary. And then we've got a bunch of schedules. So cash, the revolver, the senior debt, shareholder loan, sponsors equity and retained earnings, PP&E, and capitalized financing fees. So I'll actually start with capitalized financing fees, because that's kind of the easiest one. So just the closing balance at the end of 2013, in other words, on the acquisition date, is just, they start off with these fees here. And then in each period, we're going to take that divided by let's put in a cell here, up here. Now, this thing of having, I guess you can see that they've only put one assumption cell and just linked the others to it, so you can link across. I'd probably prefer to just have one assumption cell and link them all to that, but it's fine. And sorry, I need to make that a negative so that it reduces, and then we can see it ends up at 0, so that's good. So then we can zip back up here, might as well populate it as we go. So here's the amortization of financing fees, which is that negative right there. And the balance sheet item. Capitalized finance. Oh, that's already linked, so that's fine. Okay, cool. So PP&E, we already mentioned, that's like a balancing figure, so we're going to have to come back to that. We'll have to figure out the senior debt. So senior debt, let's again hit Alt-TUE to get to the error. Okay, so that's just pointing down here. But that should just point up to here, where we figure out the total debt, which is 4x EBITDA. So you've got, again, sorry, I should have mentioned here, you've got your sources and uses of the money. So, uses is just paying for the enterprise value, $342 million. Sources, you've got sort of half of it coming from debt. You've got $50 million coming from a shareholder loan, $125 million from sponsor equity, and that adds up to the total. And I guess that's being checked against the uses for that OK check. So anyway, I'm going to link that in there. And then scheduled amortization. We've got an assumption up here. Yes, amortization schedule. It's a little ambiguously labeled, but I'm sure that that is the amortization schedule for the senior debt. So first I'm just going to say minus the opening balance times the percent being amortized in that year. Copy that across. And then I'm just going to temporarily zero out the cash sweep and just highlight that in yellow to remind myself to come back to that, because that's the cash sweep is kind of basically the very, very last thing we're going to do. First, we'll get as much of the balance sheet and income statement right as we can. Then we'll work through the cash flows, and then the last piece of that will be the cash sweep. So then interest rate here, interest rate on senior debt is, and that's the revolver. This is the senior debt. So lock that in, copy across. And again, we're just using the opening balance times that. Now, there's one more thing that I need to fix here, and I'll just take you back to the notes where it mentions it. Yeah, amortizing loan with these percentages in each year. Scheduled principal payments are not affected by any cash swept, but stop when the full principal amount has been repaid. So in other words, for argument's sake, let's say the cash sweep is we pay off an extra 10 million here. Well, now, because I'm still having scheduled payments that sum up to 168 million, I'm now ending up with a balance of minus 10. So just a general kind of good practice whenever you have debt payments, you want to do the min of scheduled amount and the amount that actually needs to be paid, because you never pay off more than needs to be paid. And I'm going to zero that back out for now. And that's our senior debt. The shareholder loan is a pretty simple one. So we come up here to get the balance. It starts off at 50 million, and then I guess I'm doing them in the wrong order. I should have done that and that first, but anyway, 50 million shareholder loan, 16% non-cash pay coupon PIK interest, in other words, capitalized interest, which accrues annually. So again, we'll take this interest rate, link it to up here, and then the interest, the opening balance times the interest rate, and same thing here. That adds up over time. So that's that done. PP&E, are we ready for PP&E yet? Let's see. How much of the balance sheet have we filled in? We have not done sponsors equity yet. We've done everything else. Well, sponsors equity we know, because it's part of this sources up here, so we've got that 124. So let's go down to our table for sponsors equity and at least put in the opening bit. Is it here? I'm going to come back to the workings because I'll need a fully working income statement to get my net profit after tax, which I would just call net income, I guess, but I'm always wary that I'm not an accountant and I might be using these terms slightly wrongly. Okay, so, all right, to get the rest of this thing working, we need depreciation. To get depreciation working, we need PP&E, and to get PP&E, we needed the rest of the balance sheet working. So now we have the rest of the balance sheet working. So our total, again, just TUA to get rid of the arrows, our total liabilities plus equity is 372, and our total assets, aside from PP&E, cash plus the capitalized finance cost plus the receivables. So the difference between those two is 316. So that is going to be our opening PP&E balance. I guess, yeah, I will just link it down here. So equals this plus this minus this minus this minus this. Then I can come up here. Oh, and that's already linked in there. Good. Now we have our first OK on the balance sheet. We're a long way from it cooperating in the rest of the years, but one thing at a time. All right, so now let's do our depreciation. So CapEx, we have an assumption up here somewhere. Yeah, CapEx as a percent of revenue is 3%. So, and that is adding, so adding to the PP&E balance, that is. So we'll have a positive sign, so revenue times CapEx percent. Copy across. And then depreciation, everything is based on a 12-year, and sorry, I think I read this one at the start, but let me come back to it. Where is it? Here. PP&E is depreciated for tax and accounting, assuming an asset life of 12 years using the diminishing value method. Again, this is one of the things that in later years they would have kind of spelled out as a formula, because I guess these terms are not exactly the same worldwide and so on. But all this means is basically you take off 1/12 of the value each year, which does have the little quirk that you don't get to zero after 12 years, but it also kind of simplifies things when you're adding assets as you go along. You don't have to go back to your original schedule of like, what have I had for this many years and this many years and this many years. You can just say 1/12 of everything. So for a model like this, again, it's a relatively simple thing to do. So again, the assumptions told us CapEx happens at the end of the year, so we're only depreciating the original balance. So I'm going to say minus that divided by useful life, which is up here somewhere, this one. And this is a good chance for me to just look. I've used that assumption, that assumption, that assumption, that assumption, that assumption, that assumption. So I've used everything up here now except receivables and payables. So we're getting there. All right, so copy that across, and now we've got PP&E working every year. This one will get working once we have the income statement working. The revolver kind of depends on the cash sweep. We'll come to that later, and the cash obviously depends on the cash sweep, so we'll come to that later. Okay, so now we've got depreciation. Just got to point down here to wherever that schedule is. PP&E, depreciation. Okay, that gets us to our EBIT, then our interest expense. And this is pointing to a schedule here. Fine. Okay. So for now, again, I'm going to do the same thing as I did with the sweep. I want to get rid of some of these ref errors for now. So let's do this. Let's zero those out. Make it yellow. The interest expense, we can do that part. So that's our, again, this is just, there's a swap and a margin, but so in other words, it's a kind of 4% or a 4.5% spread over whatever your prime rate or swap rate or whatever it is. But the total is all we're interested in, which is the 7.5%. So copy that across, and then opening balance times the interest rate, copy that across. So now let's see what our interest schedule looks like. That's okay, that's okay. Then just interest income for cash. So again, let's, for now, zero that out, yellow. And cash interest rate is up the top here. Fill that across, and then balance times that, fill that across. Okay, so now we should be getting close to a point where these things are starting to be filled in. So that's filled in, net interest expense is filled in. Shareholder PIK loan interest we have down here. Shareholder loan PIK, and I want a negative sign on that because it's an expense, even though it's non-cash. And then tax expense, we've got, I've never totally understood why, but tax rate is very often listed as like the very first assumption in models like this. So anyway, go figure. So here we're going to say if this is greater than 0, then minus 30% block times that, which is E66, otherwise 0. So no tax in the, oops, sorry. Control Enter. No tax in the first year. There's tax in subsequent years. And now we're down to NPAT. And now we can use that NPAT to fill in this here. And where'd you go? Here. Okay, so now we're starting to have fewer ref errors. I'm going to deal with everything below here right at the end because that valuation is just once everything else is working, basically. Net working capital we still have to do. I think there's a place for that somewhere. Oh, sorry, yes, of course, the place for that is here on the balance sheet. Okay, so receivables, 11% of revenue, so that's an easy one. So it's just revenue here times 11%. Copy across. And don't worry, the balance sheet is not going to balance right away, but we'll get back to that. So then payables is 6.8% of COGS. And again, we need a minus sign there because COGS is negative on the income statement, but payables is positive in the liabilities section on the balance sheet. Okay. So we don't balance, but like I said, we're not worried about that yet. Net working capital. I think my only working capital items here are receivables and payables. Let me just check. Yeah, I think that's right. So we copy that across. Okay. So now I think we're ready to start venturing into the cash flow statement. So let me just get rid of these comments. So what are my non-cash items other than debt? I'm going to have change in net working capital. I'm going to have CapEx. We're starting from EBITDA, so I do not need to back out the non-cash interest. I do not need to back out the depreciation. And tax. The way that I like to kind of do this is just think about, the cash equivalents of everything on the income statement. So like the cash equivalent of revenue, COGS, and operating expenses feeding into EBITDA, the only adjustment there is what's the change in net working capital. In other words, the difference between your cash income and your accounting revenues and the equivalent for expenses. Cash equivalent of depreciation is CapEx. No cash equivalent of amortizing financing fees. They all get paid up front in cash. Interest and principal are both going to come down here because first we're working out cash flow available for debt service. Those are all debt servicing cash flows. PIK interest is non-cash, so that's fine, and tax. So I think we've got everything in there. So now let's do it. So net working capital, I always have to stop and think about the sign. So payables is staying about the same. Receivables is getting a lot bigger. So in other words, people are buying our stuff but not paying us for it yet. So that's bad for cash flow. So I guess I'll just go to the net working capital line, wherever the heck that was. Here. So it's this minus that. I'm used to putting brackets around it because I usually do each, this one and then this one and then this one, whatever others are on the balance sheet. But since we've got a net working capital line, I don't need to do that. CapEx is down here on my PP&E. Just need to put a minus sign on it. And then tax. I can take straight from here because there's no delays or accruals or anything funky like that. Okay, so then I have my cash flow available for debt service. So then I'll have my interest, my scheduled principal, payments, and then this is set up here to just kind of run straight down to net change in cash. I'm going to break that because I actually find it more helpful to say, let's have open, let's do it here, opening cash, and then we'll have cash available for sweep above min balance. And then we have two sweeps. We have sweep. Where's the word sweep? Here. Yes. So first we sweep to the revolving credit facility until that's paid off. Then we sweep to senior debt. So revolver sweep, senior debt sweep. And then we will have, then we'll get down to net change in cash. So I'm just going to change this formula here. It's going to be a sum of CFAs, interest, scheduled principal payments, and revolver and senior sweep. Copy across. Okay. So then, interest. I have a net interest line somewhere here. Yes, net interest expense. Scheduled principal payments are only on the senior debt, so that's here. Opening cash we can get from the balance sheet. From, importantly, the previous period, not the current period, create circularities. So then, cash available for the sweep is going to be the sum of all of these minus the minimum balance. Sorry, again, I'm not sure I mentioned that one, but need to maintain a minimum cash balance of $10 million at all times. And when there's less than that available, draw down from the revolving credit facility. So we minimum cash balance right here, 10 block. Okay, and actually I guess this should say revolver draw / sweep. Okay, so we have 22.8 million less than we need. So now I always like to pause when I'm about to do a revolver formula and make sure that I don't make it more complicated than I need to make it. So it is going to be the opening balance of the revolver plus minus the change. So in other words, if this is positive, I'll be paying it off. If it's negative, I'll be drawing on it. And it's not going. I'm drawing 22.8. Yes, that makes sense. Now, what are my limits on this? I guess minus the min of that and sorry. Oh, this is what I mean about getting myself tripped. So that and minus that. All right. So if there's, let's say, I'm just going to break it for a minute. Let's say I've got 100 on the revolver to start, and I get 300 here. I pay back 100. That makes sense. Let's say I've got, yeah, okay. I think that's working. I'm always a little unsure about that, so I'll go back and check it later, but fine. And then senior debt sweep is going to be the smaller of, sorry, minus the smaller of. So the senior debt as yet unpaid, which is senior debt opening balance less the scheduled payment, and this plus this. Okie dokie. I think that is working correctly, and then I just need to link things through. So I'll do net cash flow last, so my drawdown repayment. Let's grab that. To swap the sign. And nope, this is going negative, so that is not working correctly. Wait, just double check this is, yes, it's linking up there. Okay, so where to go negative here? So here. Yeah, that. Sorry. Oh, so it's already gone negative in the previous period. No, what? Okay, so that's 33.5. What? Did I link to the wrong thing? H90, I did. I linked to the cash flow available instead of. Oops, okay, you didn't like that. Let's be careful. So, try this again. Should be linking to here. Sorry, no, this is now the right sign. Now that I'm pointing at the right cell. Circular reference. Oh dear. Shouldn't be. Shouldn't be. But okay. Where have I? Ah, okay. Yes, sorry. My bad. So what I pointed out here, where I meant to be pointing at the opening revolver balance, I was thinking of the top of this schedule, which is the opening balance, but I was actually pointing at the top of this block of the balance sheet, which is the closing balance. So instead of row 105, which is creating the circularity, I want to be referring to row 132. So we'll fix that here and fix that here. And that's better. And we'll copy that across. And then we'll copy this across. Okay. What's going on here? think I am still screwing up my sign. Okay. This is, I know that there are simpler ways to do this, but I'm just going to spell it out longhand. So I'm going to say if this is greater than 0, in other words, if I have positive cash flow, then I'm going to sweep to the revolver to the tune of minus the min of this and this. And if it's negative, then I'm going to have to pay it off with the revolver, so just minus that. That's behaving a little better, I think. So now let's see what happens to my revolver balance. Goes up, 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 gets paid off, and stays at 0. That's much more like it. I know that there is a nicer way to write this formula, but when I'm out of practice, I just have to do it as an if statement. Anyway, it's fine. Not a problem. All right, so then the senior debt sweep, I just need to link down here. And again, that is a negative to cash, so it's also a negative to senior debt. So that's fine. And then finally, I think, net cash flow, which is here. And sure enough, you can just see the only place where the cash balance actually changes in the last period, so the balance sheet is already balanced for the earlier years, but we complete that and boom, that's our last balance check. Okay, so now we should have a work, sorry, no, I did say I'd come back to the valuation stuff at the end. Let me just take the color off that. So this enterprise value, we just need to do the exit multiple times the EBITDA, copy across. The IRR, we just need to do IRR. And everything else is done. Okay, so now let's do Q&A. Questions and answers. And how many questions are there? Let me refresh my memory. 10 questions. Okay. So question number, link, hard code. I'll do the hard code later, and choice. Okay, so first question. What is the all-in acquisition cost, including transaction costs and upfront financing costs? Which I think is handy-dandy placed right here. Yes, that includes the enterprise value and the upfront costs. So 342.7, which is a good. Okay, next, what is the closing PP&E balance in 17? PP&E 17, 287.5. Let's copy that format down so I don't have to keep faffing with formatting. And that's A again. What is the EBITDA forecast for 2018? Back up to the income statement. EBITDA 2018 131.5. That's B. Happy days. 4. Net working capital balance in 2016. Down below here, where is that net working capital? Here it is. In 2016, 38.2. That's B. Question 5. EBIT forecast in 2017. Looks like things are working, but don't jinx it. Income statement, EBIT. What year did I say? 2017? Yes, 96.2. D. Good. Whoops, sorry. D there. 6. What is CFADs for 2014? Cash flow available for debt service. Another term that I never knew before ModelOff. Sorry, what was the question for 2014? Here. 7.8, which is A. Question 7. What is the drawdown or repayment on the revolving facility in 2017? So in 2017, oh yeah, so that's the year that we pay it all back down to 0. So repayment is in brackets, so 27.9 is A. Question 8. How much cash is swept to the senior loan facility in 2017? And the answer is here, 5.5. That's B. Question 9. What is the closing total equity in 2018? Per the balance sheet, 390.1. That's A. And question 10. At the end of which year should the private equity firm exit its investment to generate the highest IRR? So just XLOOKUP. Probably not going to get an IRR higher than 100%, so XLOOKUP 1 will do. In here, returning from here, and exact match or next smaller item. And if we just scan, it looks like it is 2016, 42.6. Just make that general format. Okay, so 2016 is B. All right, let's see if I got the answers right. AABBD, AABBD, AABAB, AABAB. Cool. See what I mean? There's like almost all the answer choices are A and B. I think they were a little more rigorous about distributing those at random in later years. Anyway, that's what I got for today. Like I said, next week, maybe something a little different, plus also FMWC warm-up, and then I'll be back with 2014 questions starting after that. If you've been following along, you may consider yourself to have made it to the finals. Please feel free to give those questions a go. That's all I got for today. Thanks for watching. Bye-bye.